After studying this module, you shall be able to 1. Understand and calculate forward exchange rates and forward margins. 2. Understand the concept of forward discounts and forward premiums. 3. Analyze the role of price expectations in forward exchange rates. And lastly, computation of forward bid offer rates and forward cross rates. Introduction. In a foreign exchange market, potential players can trade foreign exchange by using different types of instruments with different maturities date. The instruments may be cash, term, spot and forward futures, swaps and options contracts. In this module, forward rate and its associate terms like forward margin, forward discount, forward premium, interlinkages between forward rate and spot rate is discussed. Apart from this, the role of price expectations in forward rates is also analyzed. At the end, the computation of cross forward rates is also discussed. Meaning and calculations. Forward exchange rate. In this section, the concept of foreign exchange rates and forward margins are developed. The forward exchange rates can be computed with the help of spot rate and the interest rates of two currencies. If in 1 year dollar interest rate is 5% per annum, $100 has a future value of $105 in 1 year from now. It follows that if the spot price of gold is $300, the 1 year forward price of gold is $315. Gold could be said to command a forward premium of $15 or 5%, as the forward price is $15 or 5% higher than the spot price. Therefore, forward exchange rates are determined in the same way as a forward gold price, except that as exchange rates involve two currencies, there are two interest rates involved. In reality, gold interest rates are not equal to 0. So, the forward gold price is a function of the gold interest rate as well as spot gold and the dollar interest rate. So, now we can define the forward exchange rate as a rate agreed today at which one currency is sold against another for delivery on a specified future date. For example, on 6 September, US $100,000 is sold against Japanese 11,851,000 yen for value 8 March at a forward rate US dollar 1 is equal to Japanese 118.51 yen. The rate is agreed on 6 September. The currencies are exchanged 6 months later on 8 March. Calculation of forward exchange rates. Forward rates differ from spot rates to reflect the differing interest rates prevailing in the two currencies. For instance, if the spot rate is US dollar 1 is equal to 120 yen and 6 months dollar and yen interest rates are 3% per annum and 0.50% per annum respectively, then calculate the 6-month forward exchange rate. By the end of the 6-month period, US $100,000 would be worth equal to 100,000 into within bracket 1 plus 0.03 into 6 by 12 bracket close, which is equal to US $1015000 yen 120000000 would be worth 120000000 into within bracket 1 plus 0.005 into 6 by 12 bracket close, which is equal to 120,300,000 yen. The 6-month forward exchange rate would be such that US dollar 1015000 is equal to yen 120,300,000. That is, US $1 is equal to yen within bracket 120,300,000 by 1015000 bracket closed yen 118.52. So, in general, we can conclude that forward rate is equal to future value of terms currency divided by future value of commodity currency. Forward margin. Spot rate and forward rate differential is known as forward margin. If the forward margin is positive, the commodity currency is said to be at a forward premium. If the forward margin is negative, the commodity currency is said to be at a forward discount. Calculation of forward margin will be forward margin is equal to forward rate minus spot rate. Interlinkages between forward foreign exchange rate and spot exchange rate. Both forward exchange rate and spot exchange rate are interrelated to each other. More specifically, forward exchange rate is derived by the spot exchange rate. It means spot exchange rate is mandatory for estimating the forward foreign exchange. Basically, spot exchange rate is independent of future uncertainty, whereas future exchange rate is a protective rate as against the unfavorable change in both the foreign exchange rate and interest rate. It is computed with the coordination of both the market foreign exchange and money market. The spot rates are the current rates of the market, where you have to make the immediate payment without any additional cost involved. On the other side, forward rates or forward exchange rate is like insurance, which is selected when you are not sure to transact in the current date but want to have today's rate for your future payment. Here, the investor does not want to expose his transaction against negative exchange rate movement. The spot rates and forward exchange rates are related to each other through the interest rate parity. So, in simple, the difference between these two rates is actually the interest rate difference of those two currencies. Currency rate of each nation is governed by its political and economic factors. Changes in the value of currency rate automatically cause the change in exchange rate values. Forward rates are also affected by the supply and demand of the currencies. Supply and demand of the currencies are influenced by several economic factors: foreign trade, political stability, domestic debt levels, monetary policy, central bank, and the activities of international investors. Capital flows, given their size and mobility, are of great importance in determining exchange rates. Your country's trade in goods and services also impact the currency rate. Thus, investors keep an eye on the trade flow of both the countries whose currencies are being traded. The currencies with higher short-term real interest rates are more attractive to international investors than lower interest rate currencies. Such currencies are more advantageous to capital mobility, which allows an organization to invest and divest internationally. Meaning and calculations. Forward discounts. Spot rate over and above the forward rate results in forward discount. Suppose if on 6 September US $1 is equal to 120 Japanese yen, that is the spot rate. Similarly, on 8th March, US $1 is equal to 118.52 yen, that is a forward rate. Forward margin, that is forward discount, is equal to 118.52 minus 120, which is equal to minus 1.48. The forward margin is negative number, indicating that the commodity currency, that is dollar, is at a forward discount against the terms currency, that is the yen. This shows that the forward price of the dollar is less than its spot price when priced in terms of yen. This indicates the fact that the dollar interest rate is higher than the yen interest rate. In concluding remark, the higher interest rate currency is at a forward discount against the lower interest rate currency. Forward premium. Forward rate over and above the spot rate results in forward premium. Suppose if on 6 September US $1 is equal to 118.52 yen, that is the spot rate. Similarly, on 8th March US $1 is equal to 120 yen, that is the forward rate. Then forward margin, that is the forward discount, is equal to 120 minus 118.52, which is equal to 1.48. The forward margin is a positive number, indicating that the commodity currency, that is dollar, is at a forward premium against the terms currency, that is yen. This shows that the forward price of the dollar is higher than its spot price when priced in terms of yen. This indicates the fact that the dollar interest rate is lower than the yen interest rate. In concluding remark, the lower interest rate currency is at a forward premium against the higher interest rate currency. Role of price expectations in forward exchange rates. It is normally understood that the forward rate is merely what the market expects the spot rate to be at the future date. On empirical ground, it is not true. The forward rate differs from the spot rate only because of the interest rate differential. If the forward rate was not as determined by equation 1, then arbitrageurs would be able to take advantage of the price inconsistency. Therefore, If it is possible to lend and borrow the two currencies, the forward price is basically a mechanical function of the spot rate and the two interest rates. For instance, if the equilibrium forward rate is US $1 equal to 118.51 yen, if someone who expects that the spot rate would fall below US dollar 1 equal to 118.51 yen by 8th March, say 6 months later on, and is prepared to sell dollars against yen at a forward rate of US $1 equal to 118 yen, that is 51 points below the equilibrium rate, he would find arbitrageurs willing to buy them. The arbitrageurs would buy dollars value 8th March directly and sell dollars value 8th March synthetically by selling dollars spot, say 6th September at US $1 equal to 120 yen and borrowing dollars at 3% per annum and lending at 0.50% per annum. Computation of forward bid, offer rates and forward cross rates. It is to be noted that in practice, in the foreign exchange and money markets, prices are quoted with bid and offer rates. So, under this section, we will be discussing the computation parts of foreign exchange rates in terms of bid rate and offer rate. Suppose spot US $1 is equal to 130 yen or 130.05 yen. 6 months US dollar interest rate is 2.90 or 3% per annum, that is 180 by 360. 6 months yen interest rate is 0.50 or 0.60 per annum, that is 180 by 360. Forward rate bids. The forward bid rate is the rate at which the quoting bank is willing to buy commodity currency. As we know that commodity currency is the powerful currency. With help of cash flow figure, a forward purchase of dollars could be represented in a form of a table. Figure 6.1, forward purchase of dollars. If the bank purchases dollars, forward it will create a net exchange position. It will become long dollars. It could square its net exchange position by selling dollars spot at the market bid rate of US $1 is equal to 130 yen. What is the procedure? It is to be noted that the forward rate is computed by considering the change in the rates of interest of two countries in money market. The cash flows could be matched by two money market transactions by taking into account the following steps. Borrow dollars for 6 months at the market offer rate of 3% per annum. Lend yen for 6 months at the market bid rate of 0.5% per annum. Now from the figure 6.1b, it is finalized that S spot rate is equal to 130, RT interest rate of term currency is equal to 0.60%, RC interest rate of commodity currency is equal to 3%, and T time period is equal to 180 by 360. That is, F is equal to S within bracket 1 plus RT by RTT by 1 plus RCT, where F is equal to forward exchange rate, S is equal to spot exchange rate, RT is equal to interest rate of term currency, RC is equal to interest rate of commodity currency and T is equal to time period, which is equal to 130.00 within bracket 1 plus 0.006 into 180 divided by 360 bracket close divided by 1 plus 0.03 into 180 divided by 360, which is equal to 130.39 divided by 1.015, which is equal to 128.463. Therefore, forward bid rate is 128.463. Forward offer rates. The forward offer rate is that rate at which the quoting bank would sell forward the commodity currency. A forward sale of dollars could be represented on a cash flow figure as figure 6.2, that is a forward sale of dollars. If the bank sells dollars, forward it will create a net exchange position. It will become short dollars. It could square its net exchange position by buying dollars spot at the market bid rate of US $1 is equal to 130.05 yen. What's the procedure? The cash flows could be matched by two money market transactions. That is, one, borrow yen for 6 months at the market offer rate of 0.05% per annum, and two, lend dollars for 6 months at market bid rate of 3.00% per annum. Figure 6.2b mismatched cash flows covered by money market, where S is equal to 130.05 and RT is equal to 0.60%. RC is equal to 2.9% and T is equal to 180 divided by 360. That is, F is equal to S multiplied within bracket 1 plus RT T bracket close divided by within bracket 1 plus RCT bracket close, which is equal to 130.05 within bracket 1 plus 0.006 multiplied by 180 divided by 360 bracket close divided by 1 within bracket 1 plus 0.029 multiplied by 180 by 360 bracket close, which is equal to 130.39 divided by 1.015, which is equal to 128.5125. Therefore, forward offer rate is 128.5125. Now, the market forward rate quoted in bid and offer terms is $1 is equal to yen 128.46 and 128.5758. Forward cross rates. It is possible to cross two forward exchange rates to determine a forward cross rate. It is to be noted that forward margins are not exchange rates. They are differentials. Due to this, the forward margin of the cross rate cannot be determined directly from the forward margins of the currencies being crossed. Example of cross rate. If an exchange rate between the euro and the Japanese yen was quoted in an American newspaper, this would be considered a cross rate in this context because neither the euro nor the yen is a standard currency of the US. However, if the exchange rate between the euro and the US dollar were quoted in the same paper, it would not be considered a cross rate because the quote involves the US official currency. Calculation of forward cross rate. Consider the following spot rate quotes. US dollar by Japanese yen is equal to 110.25 by 111.10 and US dollar by Australian dollar is 1.6520 by 1.6530. In this case, synthetic Australian dollar to Japanese dollar B is equal to Japanese yens B by Australian dollar. Synthetic Australian dollar by JPE, that is the Japanese yen 0 is equal to Japanese yen 0 by Australian dollar B. That is synthetic Australian dollar by Japanese yen B is equal to 110.25 by 1.6530, which is equal to 66.69. And synthetic Australian dollar by JP, that is a Japanese yen 0 is equal to 111.10 by 1.6520 is equal to 67.25. So cross forward rate, that is the Australian dollar by Japanese yen is equal to 66.69 by 67.25. Let us summarize. The forward exchange rate can be computed with the help of spot rate and the interest rates of two currencies. Forward rate differs from the spot rates to reflect the differing interest rates prevailing in the two countries. In general, forward rate is defined by future value of terms currency divided by the future value of commodity currency. Forward margin is a differential between spot rate and forward rate. Both forward exchange rate and spot exchange rate are interrelated to each other. A forward discount is referring to the spot rate over and above the forward rate. A forward premium is referring to the forward rate over and above the spot rate. It is to be noted that in practice, in the foreign exchange and money markets, prices are quoted with bid and offer rates. The forward bid rate is the rate at which the quoting bank is willing to buy commodity currency. The forward offer rate is that rate at which the quoting bank would sell forward the commodity currency. Forward margin of the cross rate cannot be determined directly from the forward margins of the currencies crossed. The higher interest rate currency is at a forward discount against the lower interest rate currency. The lower interest rate currency is at a forward premium against the higher interest rate currency. The forward rate differs from the spot rate only because of the interest rate differential. When it is possible to lend and borrow the two currencies, the forward price is basically a mechanical function of the spot rate and the two interest rates. It is possible to cross two forward exchange rates to determine a forward cross rate. It is to be noted that forward margins are not exchange rates, they are differentials. The forward margin of the cross rate cannot be determined directly from the forward margins of the currencies being crossed.